the first thing that I want to talk about is the Little Dipper, and I want to talk about it in the context of the market. And what I mean specifically is we need to start talking about some of these trading tactics. Okay, so when I talk about trading tactics, what I specifically want you to understand is I'm talking about the literal way orders are processed in the market. Okay? So first of all, we've got to understand a couple of things. First of all, you have supply and you have demand. Without supply and demand, nothing moves. I don't care if it's used cars, juicy fruit, water bottles. Supply and demand rules every traded market, every free market. So when you're looking at price, what you're really looking at is this struggle between the supply and the demand. So when we're trading Forex, do we mean by supply? Okay? How do we even get supply in the marketplace? Well, let me go ahead and clean this up a bit. When we talk about supply, these are sellers. Okay? People that are selling in the market have supply. Okay? You can think about this just like any other business. If you're a supplier of product, that means you have it for sale. Microsoft is a supplier of software. Cisco is a supplier of networking and other networking kinds of components. So they have things for sale. Walmart is a supplier. They would be considered a down channel supplier, meaning you've got, the actual manufacturer here who's making the thing, and they will supply it to usually a guy in the middle, either a distributor or a jobber, who will then push it out to the actual storefront, which would be Walmart. Okay? So you've got a supply chain. Well, in the marketplace, we don't necessarily have the same kind of chain, but we do have a similar type of an arrangement where we have a supply where the manufacturer here would be the banks, okay, the central banks in specific. The middleman here would be the broker, and the guy on the end would be the retail trader in our case. Okay, so that's the supply chain in the market. The banks manufacture the money. Most countries now are either completely a fiat currency or they're a very esoteric blend. And what that means is the central banks literally control the credit and the money supply. Okay, so that is, again, the supply. In the United States, we call that M1, M2, and M3. Okay, so we've got M1, M2, and M3. That's a 1. So the M1, M2, and M3 represent this actually the literal physical supply of money. The brokers are then the ones, you could even call these market makers. And again, some of them are banks. That's why I wanted to be clear. The central banks are the ones that actually control the supply. But the brokers and other banks and market makers in general will then control the supply to us, the retail traders, or just the trader in general. Okay? Oops. Excuse me. Sorry about that. I don't even know if you can see it. I've got windows popping up all over the place. So if we're talking about a supply chain, okay, so we've got the central bank, we have the market maker, and then we have the trader. Whoops. Trader, Mac, there you go.